One of the other ways to use momentum indicators to improve the odds of us getting into trends, whether it's swing trading, CFD, spread betting, whatever, and winning, is for us to look for divergences. So let me go on through those again. I know I've gone through them. And don't forget, in the monthly updates that you'll be getting, you also see divergences. So you've got, for instance, the MACD, a lower low, price makes a higher high. That suggests off the next move down, so the MACD is going sideways to lower, the stochastic has already started going lower. It suggests that that's an entry point for the price. Now the price entry points that you may have, I'll give you some examples of the ones I use, depending on how strong and confident I am with the trend. Maybe the price fails to make a new high, warning sign, and entry is when it makes a one-day low, which would be there on this next second day. That's where we'd enter on the second day. Or it depends, it might be that I need it to make a two-day low because the trend has been upwards for so long, it's so strong. When I've got a divergence this strong, then I see that as a pretty strong signal to go short. What about exiting? What about taking profits? Well, it might be close half the position if you get a one-day high or a two-day high and close the rest on a three-day high. Or you might want to play around with, if the price fails to make a new daily low, get out the next day if it makes a new high, and so forth. Depending on just how risk averse you are, you can mix this in on what your gut instinct and your feel is for the market. Similarly, again, we've got another one with Anglo-American, negative divergence, and you've got the price making higher highs over there. Classic example, MACD starts moving sideways, breaks the signal line, and bang, we're in. Now what I want to show you here is something very interesting about trend following and about momentum trading. How do we know, for instance, when we're here, that looks like a negative divergence to us, doesn't it? Yeah? And we think to ourselves, wow, it's going to be falling off the edge, and in actual fact, it doesn't. It goes down a bit and then starts rising again. So what do you do about that? And you could argue equally this one. Let me draw that more clearly. You've got, I'm so awful at drawing straight lines. You've got that one, which is this, and you think to yourself, oh, that's gone lower, and maybe you get in here, just at the one-day low. And what happens the very next day is if the market's out to get it just starts rising. So maybe you get out at your stop loss, and it starts falling again. Well, two things. First of all, guess what? That happens to all of us. We get in, we go short, the market moves against us, we get out, and bang, it moves in again. Several points I want to make, and similarly with these trades, where actually the decline wasn't as great as we might have thought because the decline was quite small. For instance, take that example. The trick is, and the way that you do this is this. Very often, you will not get the big trend. It doesn't happen 100% of the time, even with divergences. It's still only going to happen 7 times out of 10 with divergences. So, what happens with some of the mini moves that you get like that? Well, if you keep a tight stop loss, i.e. if the price makes a 2-day high or a 3-day high, you close half the position at a 2-day high, close the rest at a 3-day high, then you should, on the whole, come out okay. In that, you'll either break even or make small losses, very small losses on those kinds of things where it doesn't quite come out, and you do that 3 times out of 10, but guess what? You get into one of these, and it makes up for all of these, and then some. Yeah? So what you're going to have is you're going to have quite a lot of sort of small ones like that, but the trick is that the losses, when the trend hasn't worked, are quite small. Because what you're doing is, think of it in a way, I don't know, think of a football match. Imagine that's the goal. And if you're into football, you know what happens. The striker runs in a game about 100 times he makes a charge this way. And only once in a game does the football come in and he scores a goal. And it's a bit like that. What we're doing is, we're making that charge, we're running in, hopefully going to catch a goal, i.e. catch a trend. But if we don't, fine, cut our losses, go back again. The mistake that many traders make is, when they get in short here, they don't put a stop loss, the price goes against them, and they lose a fortune. And because they've lost a fortune, they're desperate for wins, so every time something does move like this one in a big way, they sort of go a little bit and take that win here, so they don't let their profits run as the price keeps on falling, and they get out too prematurely. So they're doing the opposite of what any professional proper trader would do, which is they're letting their losses run and they're cutting their profits short. Yeah, so that's divergences over there, and we'll start looking in the next chapter again more examples.